Good evening. My name is Jackie Knight. I'm the Corporate Training Director for STC, and I'm happy to welcome you to this evening's webinar, totally on Q&A. So we're going to get started right away so that I'll have lots of time for your questions. Before I do start, I do need to give you a bit of information about STC. We are a retirement plan administrator, so we do not provide legal, tax, or investment advice. We are not a registered investment advisor. We don't represent or sell securities or any investments of any kind, and we don't represent or endorse any particular investment opportunities. And I will talk about some different types of investments that are available to a self-directed retirement investor. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investment. Now, this evening's webinar is primarily Q&A, but I am going to start with some basic information in case I have listeners in the audience that self-direction is new to. So we're going to talk about self-directed retirement accounts, investment options, guidelines that must be followed in retirement account investing, the retirement account structure that STC uses for each of our clients, and the services that we offer. And then I will get to your questions. So getting started right away, I do want to define what is meant by the term self-directed retirement account, because it is not a type of retirement account. What it means is that you hold your account with a company that permits you to choose any type of investment that is allowed by law, by the IRS rules, by the Department of Labor, the ERISA rules. Anything that is permitted to be owned in a retirement account, you can own. You need to work with a particular type of company that permits that. And that would include what some consider non-traditional assets, like real estate. Self-direction also means that you manage your retirement plan's investments. You make the decisions related to those investments. And ultimately, you have significant control in a self-directed retirement account, control over the decisions that affect the value of your investments. Now, there are a number of different types of retirement plans. The first two I'm bringing up on your screen are traditional IRA and Roth IRA. You may be familiar with those. Individual retirement accounts or arrangements. Both of these accounts have the same maximum annual allowable contribution, and that is $5,500 or $6,500 if you are 50 years or older. You can contribute that maximum amount of your earned income for the calendar year. The difference between these two accounts is that with a Roth IRA, your contributions are taxed. With most retirement account contributions, they are not taxed. They are pre-tax, but with a Roth, they are post-tax. And what that results in is that when you begin taking qualified distributions after reaching age 59 and a half from a Roth account, those distributions are not included in your taxable income. So that means that any growth that your retirement monies have had in the Roth account are not taxed when they are distributed. A traditional retirement account distributions, like others, once you take the distribution, it's included in your ordinary income on your income tax return. So that's the difference between the traditional and Roth IRAs. A SEP is a simplified employee pension plan, and that's another type of plan that allows larger contributions. If you happen to be self-employed or have a business, you may want to set up a SEP account. The maximum contribution for a SEP account in 2017 is $54,000 from the earnings of your business, your company. A simple plan is a savings incentive match plan. Sometimes small business owners or partnerships or sole proprietors might use a simple plan. Again, allows you larger contributions. For 2017, the maximum contribution for a simple plan is $12,500. If you are 50 years or older, you can add $3,000 to that for a total of $15,500. Now, I've brought out onto your slide 4 different plans that say former employer. 401k is a for-profit corporate type plan. 403b, charitable organizations or nonprofit organizations might have a 403B plan. TSAs are tax-sheltered annuities, TSPs, thrift savings plans. If you formerly worked for an employer and participated in one of these types of plans, then you can roll or move the money out of those plans into a self-directed plan that you qualified for, a traditional IRA or a SEP or a simple plan. And then, of course, there is a traditional 401k, a corporate plan. All these monies can be self-directed, again, if you move them into a self-directed account with a self-directed administrator or custodian. I want to talk now about some investment options that are open to you when you have a self-directed plan, because having a self-directed plan means, again, that you can invest in anything that is permitted by law. So there are many different types of real estate investments that you can hold in a self-directed account. Single or multifamily homes, vacation investment property, and you'll notice that I have the word investment here, and that is by design. You cannot personally use a vacation property that your retirement account owns. That is not permitted. It violates some rules I'll talk about in a moment. But if you certainly can own vacation investment property that you rent out or and receive rental incomes on. Tax liens, another kind of real estate investment, raw land or building lots, commercial buildings, real estate syndications where you might go into an investment with other investors. So it's a syndicated investment and you can participate in those in a self-directed account. Mortgages and loans. You can purchase real estate-backed mortgages. You can make loans from your retirement account. You can invest in private businesses. Some precious metals, not all, but the government has defined, the U.S. government has defined what precious metals you may invest in. If anybody has questions about that, I can give you some more details. You can also invest in the Forex market, the foreign currency market, options, futures, and of course you can include stocks, bonds, and mutual funds in your self-directed retirement account. So really anything that is permitted by law, you can invest in a self-directed account with security trust company. Now there are guidelines that are established by the IRS for retirement accounts. There are some things that you may not invest in. There are prohibited assets, life insurance contracts, and collectibles, things like works of art, stamp collections, coin collections. Those are not permitted as investments in a retirement account. There are also some transactions that are prohibited. Keep in mind that your retirement account is meant to benefit you once you reach retirement age, and it's given a tax-deferred, tax-preferred status for that purpose. So the transactions that you engage in your retirement account do need to be for the benefit of the plan. You cannot personally borrow money from your retirement account. You also cannot pledge your plan assets to secure a personal loan. Now, I have seen loan applications that want to see your retirement accounts listed, and they can be listed on the loan application, but they can't be security for that loan. You also cannot utilize your personal credit or guarantee to obtain a loan for your retirement plan. Now, you can certainly purchase, your retirement can purchase a real estate property and leverage it. In other words, get a loan for that. But it can't be a loan that you have personally guaranteed. It must be what's called a non-recourse loan. That means that the lender, if there's a default on this loan, only has recourse to the property that the loan is on. No other recourse, so no recourse to you personally. So it cannot be a personally guaranteed loan. You also cannot benefit any disqualified person with a transaction in your retirement account. So let's talk a little bit more about these disqualified people. Who are they? You'll see the first person I bring up is you. You and your retirement plan are two different entities. and you and your retirement plan cannot do a direct transaction. So, for example, if you own a property at Myrtle Beach, your retirement plan cannot purchase it from you. That would violate this disqualified person prohibited transaction rule. There are other family members who are also disqualified, ascendants. So that would mean your parents, your grandparents, your great-grandparents are all disqualified. Also, your descendants, your children, your grandchildren, your great-grandchildren are all disqualified. However, lateral family members are not disqualified. So that would mean brothers and sisters, aunts and uncles, nephews and nieces, cousins. None of those parties are disqualified to your to your retirement account. So back to that example of that property at Myrtle Beach, if your father owned it and your retirement account could not buy it from your father. If your daughter owned it, your retirement account could not purchase it from your daughter. But if your brother owned it, or your niece owned it, or your third cousin owned it, then your retirement account could purchase it from them. So just some things you want to keep in mind when you are thinking about transactions for your self-directed account. And I should also mention that you, at that top, includes your spouse if you are married. So if your spouse owns that property, your retirement account cannot purchase it from your spouse. There are also two entities that are disqualified persons. Any company, if you are a majority shareholder, and any company if you are an officer, a director, or a highly compensated employee of that company. Those entities are also disqualified persons. Now, I want to just briefly touch on the structure that STC uses for each of our clients' accounts. We use an LLC structure. We actually set up an LLC for each client account, and we do this because there are some significant benefits to our clients of doing this. First off, it offers you maximum flexibility in structuring complex transactions. If you are using leverage, if you have multiple parties to the transaction, in other words, there are going to be several owners of the asset, including your retirement account, they can make the transaction complex. So using an LLC structure gives you a lot of flexibility. It does also provide an additional layer of asset protection because it is a limited liability company, albeit it is a very specialized LLC. It is designed by our attorneys to be owned by a retirement account. So its articles of organization and its operating agreement all comply with the rules relating to retirement accounts. So it's a very specialized kind of LLC. It also gives you, the client, checkbook control over your retirement funds, which means you have an immediate response to investment opportunities. Now, we do not actually give our clients the checkbook for their accounts, and we do that by design. We don't want you to get yourself into a predicament by maybe inadvertently engaging in a prohibited transaction. So what we do instead is we actually co-manage this LLC. You send your documents to us, either email or fax, however you like. We immediately review that transaction, and then we can same-day fund that investment, get the money to the seller, and get that investment into your account. But you have our experts reviewing the transaction to make sure you're in compliance with all of the rules. So we can same day fund those transactions if we get those documents by 2 p.m. Eastern Time, or otherwise it would be the next business day. This does also simplify asset titling, having this LLC structure. All of your assets will be titled in the LLC's name. So for example, if you purchase a piece of real estate, you can actually go to the closing and sign the documents on behalf of your LLC retirement account. You don't have to send the closing documents to our office where they sit on somebody's desk waiting for signatures and then getting them back to you. That is not how we operate. You can actually go to closing for a real estate purchase. This structure also makes pooling with other sources of funds very straightforward. It simplifies that process. So let me just show you a little schematic of that. Here you see our retirement plan structure. You'll see the current custodian on the upper left. You would direct them to transfer or rollover funds to our self-directed custodian. We would set up that LLC in the state of your choice. The money is moved from the custodian to a bank account that your LLC has access to. And here you see your account has 3 investments. Investments 1 and investment 2 are wholly owned by your retirement account. But investment 3 actually has 4 co-owners. One of them is your retirement account, 1 is your father, 1 is your daughter, and 1 is some of your personal money. Now you might be thinking, wait, you told me those people were disqualified parties to my retirement account, and they are. However, if you co-invest at the inception of the purchase transaction, then this does not violate those disqualified person rules because each of you is doing a transaction with the seller. So we can help you structure a transaction where you have otherwise disqualified parties involved, but keep it a transaction that is allowable. Now I want to just quickly go through STC Services, and then we'll get to your questions. So I hope you are putting your questions in that question box. We do offer that retirement account LLC structure setup. So we create the LLC, we coordinate the transfer of the funds from your current custodian to our custodian, then to the bank account. We offer you that protected checkbook control. We have CPAs and attorneys that can answer your technical questions. We offer you unlimited guidance on transaction compliance. We handle all the back office support. There are reports that need to be done every year, annual valuations. We take care of all of that, all of the administrative function for your retirement account. We will maintain financial statements of your LLC that you will have online access to so that you can really operate your retirement account as a business. You'll see a statement of cash flow, balance sheet, income statement. We supervise the regulatory reporting and we oversee the annual valuation. So we really take care of all of that administration for you. Now we are going to move to the Q&A section. I hope that was just a little preliminary information that I hope was helpful for those of you that are new to this. So let me open up my question box and see what questions I have. Okay, I have a question about what about a purchase from in-laws, spouses, parents? That would be the same as your parents. It would be a prohibited transaction. They would be considered disqualified parties. So if you have any familial relationships that you're interested in knowing how that would work, you can contact our office and we can help you with that. This is kind of an account-specific question, so I will say the question in case anyone has this particular question, but I will not be able to answer it. How does someone fix their taxes if they did not do their, I'm assuming they mean RMD, required minimum distribution, properly from the beginning using the self-directed IRA. Let me just address what this person is asking. If you have reached the age 70 and a half or will during the calendar year, you do need to begin taking RMDs, required minimum distributions, from your required retirement account. And I actually had a question I received beforehand about how they were calculated. So let me just add that in here. How is the RMD calculated? Is it based on total assets, or cash in hand, or equity? Was the question I had received. Your RMD is calculated based on your prior year-end balance of all of your accounts. So for 2017, we'll say that would mean the balance of all of your accounts on December 31st, 2016 would be added together, and then the IRS publishes tables based on if you're married or you're not and your age, and that you get a multiplier that you, a divisor actually, that you need to divide your balance by, and that will tell you what your required minimum distribution is for, say, 2017. Now, if you didn't calculate that properly, then you will need to talk with your accountant about how to fix that, because that required minimum distribution is added to your taxable income for the year for 2016. So you will need to talk with your accountant about that. The individual who asked me the question prior asked what the RMD was based on. So just to reiterate, it's all of your accounts in aggregate. If you have multiple accounts, their balance at December 31st, and then that life expectancy factor that the IRS publishes. Now, if you own real estate, I often get a question about that. I've got real estate in my retirement account, and I'm required to do an RMD. I don't have sufficient cash. What do I do? What can I do? You may not want to liquidate that property. So you can do a partial distribution of the property's ownership to yourself personally as part of your RMD or all of it. And now that property would be co-owned by you personally and your retirement account. What that would require is your property would have to be appraised. So then the fair market value, and in fact, to calculate the RMD, your properties will need to be appraised, and that becomes the value of your property in your account. So basically, the RMD is based on the entire value, property, cash, loan values, whatever your balance is in that account, that's what your RMD is based on. If you do have more than one account, again, that's calculated on the combined balances, but you can take the distribution from a single account. So we want to talk with your tax accountants about that and how to do that. They should be able to help you calculate the RMD. Your custodian should get those monies to you. So the RMD. Okay, another question. I have money in my account that is idle from time to time, and it could be for a long period and an indefinite period. I would like to earn a return by buying short-term instruments that will earn more than the bank interest rate. Any options? Well, you could certainly open a brokerage account in your self-directed retirement account where you could, as that owner, trade. That brokerage account would need to be titled in your LLC's name. We would require you to send us the monthly statements for that, because we need to make sure that you're not taking withdrawals from that account or putting money into it, because it is owned by a retirement account. So it has to flow through the retirement account into the brokerage account and out of the brokerage account. But you could do that. There are some shorter-term investments you might be interested in. You might want to do a tax lien. Generally, I think those are 2 to 5 years, depending on the jurisdiction. You might want to make a loan. You could determine the length of the loan, the terms of the loan. So there are some things that you could choose to do that would be a shorter term and still get your monies invested instead of just sitting in a bank account earning a minimal amount of interest. Okay. Can I invest in seed/startup investing in my retirement account? I would be investing for an equity stake partner partial ownership. So it's investing in a business basically, and as long as the entity that you're investing in permits retirement account investors, and as long as the investment doesn't violate any of those prohibited transaction rules, then it should be a viable investment. So you let's say it couldn't be your spouse's new business because your spouse is a disqualified person. But it, could be some non-family member. It couldn't be in a business that you have a majority interest in already starting up. So you will need to make sure you don't violate any of those rules. One thing you may want to keep in mind if you are investing in a business, you may need to look into whether or not how you are going to receive your earnings, whether or not that will trigger UBIT. UBIT is a tax that sometimes, in rare instances, does apply to a retirement account, which is normally tax-deferred or tax-free. UBIT stands for Unrelated Business Income Tax, and if you would like more information about that, I do cover that in more detail on another webinar that I have previously recorded, so you can check that out on our website. Okay, I have both a Roth account and a former employer 401k plan. Can they be combined in the same LLC? Unfortunately, they cannot because they are two different kinds of money. Remember I said that Roth funds were post-tax. In other words, you paid taxes on the monies that you put into the Roth account, whereas monies that went into your 401k were pre-tax. So they are two different kinds of money, and they can't be combined into a single account or LLC. The only thing you could do is you could convert the monies from the 401k into Roth funds, which does have a taxable consequence, but you could convert them to Roth funds, and then they would all be Roth money, and they could be in a single account. But again, a Roth conversion does have a tax consequence, so you would need to talk with your accountant about how that would affect, affect you, and if you wanted to pay those taxes. And I got another question. How are taxes calculated on assets that are converted to a Roth account? The taxes are paid on the market value of the account assets as of the date of the conversion, and then they would be included in your income, so it'd be taxed at your ordinary income tax rate, whatever that is. Again, always check with your accountant if you're going to be doing that kind of a transaction, because they can be more, they'll know your tax situation, they could be very specific with you. Okay. I'm getting some very interesting questions. Can my retirement account purchase additional interest in a property I'm already invested in? And that's a real straightforward answer. The answer is no. If you already have an ownership interest in a property, your retirement account cannot invest in it. You can't do a direct transaction with yourself. Can I purchase a property with funds in my retirement account and then sell that property and hold the mortgage for the new buyer in my account? Yes, there would be nothing wrong with that transaction as long as the buyer isn't a disqualified party or person. And then, of course, you would probably want to make sure that the mortgage, that the property was the collateral, so that if there was a default on that mortgage, you could foreclose on that. Your retirement account could foreclose on that. So yes, you certainly can do that. Oh, here, can you give me some ideas for possible investments for smaller accounts? Back to tax liens, those are generally much smaller investments. Private notes, lending to others. You could also partner with others so that you didn't have to fully fund the investment by yourself. I see very many people partnering with other investors to do that kind of thing. Can I use funds from my retirement account to purchase a franchise? Owners, if permitted, you would not be able to be active in running that franchise. It would need to be a passive investment, again, because of the disqualified person rules. Can you make a maximum contribution to both a regular and a Roth IRA in the same year? No, you cannot. You are limited in total to the $5,500 or $6,500 amount. So you can make contributions to both a traditional and a Roth, but the total cannot exceed $5,500 or $6,500. Okay, this is a rule. Somebody asked me this, I've actually been asked this question twice. Does the enabling rule still apply? And here's kind of what the background is to that. Can someone combine personal money and retirement account money to fund an investment? Let's say, and then this person gave me an example. The minimum participation in the investment is $40,000. Could personal money provide $30,000 and the retirement account provide $10,000? The enabling rule basically is something the IRS says that you can't do a transaction just to enable a personal benefit from it. And that rule does apply. You must be in a position that you could have accomplished the transaction without the use of the IRA. So you didn't have to use it, but you chose to use it because it was a good investment for your IRA. So the enabling rule does apply, but as long as you can show that you could have funded that transaction without using the retirement account, it should be fine. So you want to check with your accountants about that as well. But it does apply, but you certainly can partner personal money with a retirement fund to invest in an investment. It looks like I'm starting to get some questions about real estate purchases. I want to start investing in real estate, but I don't have enough money in my IRA to buy a property outright. Do I have any other options? Well, you do. You could certainly partner with others. As I showed you on that schematic, you can partner with others and co-own investments, so you wouldn't wholly own it. So you could partner with others. You could also get a loan. You could look for a non-recourse lender. There are a number of them. I actually have a previously recorded webinar with a non-recourse lender on our website that you could listen to and do some research to find a lender and talk with them about what they would require. But it would need to be a non-recourse loan. So those are really kind of the only two opportunities if you have insufficient funds standalone. And again, you can partner with personal funds as long as you do that at the inception of the transaction. This isn't really owning a property, but you could also lend money to a real estate investor and have that property be the collateral for the loan. If the loan, was not, if there was a default on the loan, then you could foreclose on that property, and then your retirement account would own it. So those are just a couple of options. If I have a rental property in my account, who does the renter send their rent check to? And that really depends on if you're using a property manager, which we do recommend you use a property manager to make sure that you don't violate any of those disqualified person rules, because you really can't do anything significant related to your rental property. You can't go and fix a window or install a new dishwasher. You cannot do those kinds of things for a property that's owned by your retirement account. So we do recommend that you use a property manager. If you use a property manager, then generally the renter would send a rent check to them, and they would deduct their fee and any incidental expenses, and then they would forward the remainder to STC, and that would be deposited into your retirement account. Otherwise, they could mail the check to you and you send it to us, but again, that rental check must be made out to your retirement account owned LLC. If that rental property is in your retirement account. It must be made out to the LLC, and then that will be deposited into the bank account that your retirement account has access to. Okay, here's somebody asking about the LLC. Can't I just form a business LLC on my own? I already know how to do that. Actually, that is part of the service that we provide, and we do that to make sure that the LLC is structured so that it can be owned by a retirement account. Our attorneys have made certain that it is in compliance with the IRS and the DOL and the ERISA rules. So it is not a generic business LLC. It is a very specific LLC, and that is part of the service that we provide you. Why does STC hold the checkbook? We have done some research, and it has been reported that a large number of transactions that are completed when in self-directed retirement accounts are actually prohibited. And it's not because the IRA holders are trying to cheat the IRS. It's simply that they don't know all of the guidelines. So that's why STC reviews every transaction. We ask questions as needed, who are you buying this from, who are the other parties to this transaction, to help ensure that you're not placing your IRA funds at risk. So this is one of the STC rules that makes us unique. And even though we provide this service, we're still able to disperse your funds the same day if we have that paperwork by 2 p.m. Eastern Time. Okay. Okay, this is relating to the LLC setup. My state has a high annual LLC. Can I use a different state? Yes, actually, you can use any state that you would like to. We do have a registered agent company that we can use to assign you a street address in the state that you'd like to establish your LLC in if you don't already have your own registered agent. There is an additional fee for using this. It's a small fee on top of any fee that the state would require to keep your LLC in good standing. So if you plan on purchasing real estate within your account, we generally recommend that the LLC is set up in the state where you plan to purchase the real estate. That makes things much more straightforward. But when you are setting up your account with us, you can talk with our operations manager and discuss, what you're planning to do, and then they can give you some additional information that will help you make a decision on where you want that set up. Okay. Okay, this is a good question about a loan. Does STC choose the terms of my loan? No, we do not. This is truly self-direction. You will choose the terms of the loans that you make from your retirement account. What we will do is we will make you aware if any of the terms are items that might raise a red flag in an IRS audit, because they are looking at self-directed retirement accounts. More and more people are starting to put funds in self-directed accounts, and so they are monitoring that. So you do need to keep in mind, that, for example, if you're making a loan, you're loaning funds for 5%, for 5 years at a 1% interest rate, that would look a little fishy. Your goal for the IRA is to increase in value, and the IRS would wonder why you would make a loan at such a low rate to someone when they could never get that rate from any other type of vendor. So we won't tell you that you have to change the rate, but what we would do is we would let you know that that could raise a red flag and that could be putting your IRA at risk. So we would let you know that. Okay. What are my options for payment of the account setup fee and the management fees? You can pay for those from personal funds, or they can be paid from the monies in your account. That's entirely up to you, and you can make that choice. Okay, how difficult is it to own rental property in a self-directed IRA? Would I need to keep plenty of cash in the account for repairs and maintenance? Would I be allowed to manage the property? Okay, well, first off, as I mentioned earlier, we would encourage you to use a property manager. You know, typically the property manager collects the rent. They hold a retainer for emergency repairs. They charge a percentage for their services, and then they forward that, whatever's left over, to your IRA LLC. And they'll send us a statement and a breakdown of rent and expenses. For the property manager, please keep in mind you cannot use a disqualified party. So you can't be the property manager, your spouse, your children. Now your brother or your sister could be the property manager because they're not a disqualified person. We do not require you to keep a certain reserve for your rental properties in your account, but you do want to keep in mind that like with any property, you know, things do come up, and any expenditures for anything that comes up must be paid by the IRA. So you'll want to be sure that you have access to IRA funds, or that you're eligible and able to make a contribution to your IRA if you need funds in there to pay for a new washing machine or a broken window repair, whatever. So you'll want to be sure, because monies do need to come from your retirement account. You can't pay those personally. And I'll just mention here, if you co-own a property, let's say you purchased a rental property, you put in 50% personally, and your retirement account put in 50% personally, then that means that all of the rental incomes, all the incomes are split between you personally and your retirement account, and all the expenses are split 50-50 also. So if you own a rental property 50-50 with your retirement account, and you needed to replace the roof, and it was $3,000 to replace the roof, then you would personally have to pay $1,500 for that, and your retirement account would have to pay $1,500. You'd have to split everything in the pro rata ownership proportion. Okay, got a long question here. Okay, I'll read the question as it's written, and then I'll kind of explain it. If through the LLC you invest in property, once you retire and are eligible to draw off the IRA, can you move into the rental property that was once off limits? So what the scenario is here is the individual owned a rental property in their retirement account, and they've now reached the age of 59.5, and they can begin taking distributions from that retirement account penalty-free. You could move into that rental property, but only once it was fully distributed to you. So let's say this rental property was $150,000. Probably pretty low, but we'll say it's $150,000. And you have now reached age 59.5. You can take that full value as a distribution, $150,000. It will be taxable to you unless it was in a Roth account. So if you take it as a distribution, that the value that is distributed, we'll say it's a fair market value of $150,000, now is reported on your income taxes, and you pay taxes on it, and now you own it. Your retirement account doesn't own it anymore, so it needs to be retitled in your personal name, and now you can move into it. I've also been asked the question, you know, if I'm required to take a required minimum distribution, you know, but I've got this piece of property in my account and I don't want to sell it. Keep in mind, you can retitle it. So let's say your required minimum distribution is $10,000 for this year. and the property is valued, you have an appraisal done, it's valued at $150,000. Well, you can take $10,000 of the value of that property, retitle the property in now your name personally as an owner of $10,000, and your retirement account owns $140,000. So you co-own it. You cannot move into that property personally until it is fully distributed. As long as your retirement account owns any portion of that, you cannot use it personally. But I do know people who have purchased their future retirement home with their retirement funds, and then they've distributed it to themselves maybe over several years to pay the taxes on it, and then moved into it once it was fully distributed to themselves. So yes, that is a possible investment and a way to use that property personally once it is fully distributed to you. Okay, does a loan I make from my IRA have to be secured? No, it does not have to be. The IRS does not require that. However, of course, your IRA's investment is more protected if it is secured. You will also want to be sure that in addition to having that collateral, the property listed in the note, you want to be sure that there is a lien placed on that property too. So that would be something that a function that you would fulfill for on behalf of your retirement account. But you're not required to, but that you can certainly make that a requirement of the loan that you want to do. Are groups such as yourself restricted to handling accounts within a limited region of the country, or do you handle accounts nationwide? STC handles accounts nationwide, so you can choose any state for the incorporation of your IRA LLC. We have clients in all states all throughout the country. By the way, just for your information, we happen to be headquartered in Maryland, in Hagerstown, Maryland. Okay, if I want to purchase a bank-owned house, so this house has gone into foreclosure and the bank has taken it back, they often require verification of funds. Yes, they do. How would I verify funds that are in my self-directed IRA? Well, we can provide you with a proof of funds letter. What we would ask you to do is call us or send us an email, and we'll prepare that letter for you, and we can email it to you, you know, in 24 business hours, in less than that. What we would want you to do is we would want you to tell us the amount of funds that you want listed in that letter up to the full value of your account. So let's say you have $500,000 in your account, but you're buying a house for $200,000. You may not want the bank to know that you have $500,000 in your retirement account, so you can tell us to put in that verification of funds letter the amount that you want up to the value of your account. And we can get that letter out to you right away. Do I have to pay taxes on the income that is generated by my IRA? Normally, no. Retirement accounts are generally given tax-deferred treatment, or actually tax-free with Roth accounts, as long as it's a qualified distribution. But there are some exceptions. If you use a non-recourse loan that I mentioned earlier to purchase property, then you may have to pay UDFI, unrelated debt financed income tax. That is a subset of UBIT, unrelated business income tax. It can come into play if you use a non-recourse loan to purchase a property. I do talk about that in one of my previously recorded webinars, so you can go to our website, or you can also email me directly, and I can address that a little bit more. And in fact, while I'm taking these last questions, let me just quickly, before I close with a couple of last questions, you know, if if you know that you're interested in opening a self-directed account, we can get that started for you right away. Just get in touch. If you have clients or colleagues who would be interested in learning more about self-direction, you can certainly direct them to our webinars. You can give them my contact information. They can get in touch and ask any questions personally. Or if you simply need more information, we do have a lot of information on our website. So I have that listed for you, stcira.com. Our corporate number is on the screen, as well as my direct contact information. You can ask me questions, and that is my direct phone line, so you can call me directly as well. So please do let us know how we can help you. Let me take just a couple more questions before I close out here. Okay, this is a little complicated. Okay, let me see. I think I had two people ask a very similar question. I was just going to see which one was easier to say. Okay, well, we'll just, can I decide to roll over a portion of my 401k corporate plan to a self-directed account? If you're still employed with the company, probably not, but there are some exceptions. In fact, I have just been talking with someone who has an exception and is doing that exact thing. So what you want to do is go to your company's plan administrator and talk to them and ask them about what you can do. Sometimes if you've reached a certain age, or if you brought funds from a previous employer into this current employer's plan, you can probably move those out. Now, another question I got earlier, and I can't find it right now, someone was said that they thought they had read that you could only do one rollover per year. And so they were concerned about, you know, if I move money to you now from an account, just a portion, and then I want to move more later this year, can I do that? Well, let me explain what you can and can't do. You can certainly transfer custodian to custodian, from your current custodian to our custodian, any number of times during the year. Custodian to custodian, you can do as often as you want. What you cannot do is take a rollover where the custodian, your custodian, sends you a check, and then within 60 days, you deposit that check into a retirement account. You can only do that one time per year, and that is for all of your accounts in aggregate. So if you've got a set plan and a corporate plan, if you have multiple plans and you can only do a rollover, which is the custodian sends you the check one time per year from all of your accounts, not one time per account. I hope I was clear about that. That has confused some people. Okay, just a couple of last questions. If I'm considering a Roth conversion, should I do that prior to transferring or rolling the funds over to you? And if so, are there additional fees associated with the conversion? It does not matter to us. We don't care if you do the conversion before or after. If you choose to convert through STC, we will supply you with the conversion documents with your initial paperwork packet. We'll provide you as much assistance as we can with the conversion. We'll keep you posted on the progress, and there is no additional fee from us for doing a conversion, so there's no fee charged for that. So you may want to check with your current custodian to see if there is a fee to do a conversion. Maybe you just want to move to us and not pay that. I would like to tell my CPA more about your services. Do you work with these types of individuals to set up accounts? Yes, actually we do. We would be happy to discuss with your CPA any kind of information they might need to help clients of theirs with self-directed accounts. So yes, we'd be happy to do that. I also know that sometimes I have real estate investors and realtors online. So if you have friends who would need more information, I'd be happy to talk with them. Just have them get in touch with me. So thank you all for joining tonight. I am going to close out, but I do want to tell you that we will have a webinar coming up in July. Normally they're on the first Tuesday, but that happens to be the 4th of July. So we will have our next webinar on Tuesday, July 11th. Please do join us and invite any other friends to join us. We really want to help you get the information you need about self-directed retirement account investing, and we would be happy to be of service to you to help you get started if you would like. So please do get in touch. Thank you so much for joining me tonight. If any questions come to mind after the fact, please feel free to get in touch with me directly. Thank you. Good night.